Hello everyone. Here is Vita Investor and today I am going to explain what is bonds, and its components. Please subscribe, and hit that bell to receive more videos on the stock market, and financial advice. Leave a like to support the channel. Let's start this video explaining what is bond. So, bond is a fixed income instrument, that represents a loan made by an investor to a borrower. In other words, bonds are units of corporate debt issued by companies, and securitized as tradable assets. Also, bonds are considered as a fixed income instrument, because bonds pay a fixed interest rate to debt holders. And, bonds are used by companies, states, and governments, to finance projects. Now, let's talk about the components of a bond. First, you have to understand what is face value. So, it is the amount of money that the bond will be worth at its maturity date. Then, what is maturity date? It is the date on which the bond issuer will pay the bondholder the face value of the bond. Another component is the coupon rate, which is the rate of interest that the bond issuer will pay on the face value of the bond, expressed as a percentage. Let's see an example. A bond has a coupon rate of 4%, and has a face value of $1,000. Then, 4% of $1,000 is equal to $40 per year. And, finally, the coupon date. It is the date on which the bond issuer will make the interest payment. The intervals can be annual or semi-annual. Also, there are four main types of bond. The first one is corporate bonds, which are issued by companies. Then, the second one is municipal bonds, which are issued by states and municipalities. The third one is government bonds, which are issued by the government. And finally, the last one is agency bonds, that are issued by government-affiliated organizations. So, what are the risks of investing in bonds? The most well-known risk in the bond market is interest rate risk. This is because interest rates have an inverse relationship with bond prices. When you buy a bond, you agree to receive a fixed rate of return for a set period. Also, the worst enemy of a bond is inflation. Let's see an example. If the coupon rate of the bond that you bought is 5%, and inflation is 4% during that year, then, you will get only 1% of return. After seeing the risks of a bond, we will now understand why it is good to invest in it. So, if you invest in bonds, and hold all the way through its maturity date, the return that you are going to get on your investment is already predetermined. Also, there are less downside risks comparing to stocks, for example. This is the end. Thank you everyone. But, remember that before buying any bond, please, do your own research and check which one is better for you. Do not forget to like and subscribe.